The biggest second round effect will continue to be a pressure on commodity prices.
We took around $250 million of additional provisions for Russia exposures.
I'm excited to see what he's going to do with the company when it is private.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Sealing the deal, Elon Musk wins Twitter for $44 billion. The tech giant's shares jump. European banks kick off the reporting season. HSBC and UBS both beat on profit despite the war in Ukraine. More from our interviews with the chief financial officer of HSBC and the chief executive of UBS this hour. Plus, to the rescue, the PBOC pledges to boost support for China's economy as virus testing is expanded to most of Beijing. Now, let's check in on the markets first, and really the markets kind of distill all of these tensions or actually support from PBOC. You can see we're seeing a nice little lift for the European stock 600, gaining some 0.7%. Technology also gaining 0.6%. Look, a lot of these European equities, first, it is earnings season, and we have a lot of stocks that actually beat estimates, but also they rebounded from a 6-week low, again, as risk appetite has returned after China's central bank pledged to support the economy. Our Tom McKenzie was reminding everyone, once they've said it, then they need to follow through. Bitcoin, 40,060, and then the U.S. dollar index, the one thing that we've been watching incessantly to give us a good idea of also U.S. financial conditions. Mark Cudmore with a great chart earlier, actually, looking at the financial conditions in the U.S. and how they differ from the ones in China. Now, this is a picture overall. If you look at the individual European countries, again, we look at oil. We always look at oil to give us a sense of how much independence a lot of these countries can actually achieve from Russia if there was to be an oil embargo. Overall, though, we're seeing similar gains across the board. I'm looking at the sectors, and all of them are up. You can see the FTSE gaining some 0.7%, the DAX almost 1% higher, and the CAC 40 and the FTSE MIB over into the 0.5% higher. Now, Elon Musk agreeing to buy Twitter for $44 billion. Now, it will be one of the biggest leveraged buyout deals in history to take the 16-year-old social networking platform private. Joining us now is Bloomberg's Laura Wright. So, Laura, this has been, of course, talked about for a long time. $44 billion. Why is the board finally behind them?
The board's behind it, Francine, because of the magic number, $54.20. That's what shareholders will receive. And look, that represents a 38% premium from the social media platform's closing price on April the 1st, the last session before we learned that Elon Musk had become the company's largest shareholder. Now, Elon, he submitted that unsolicited original bid back on April the 14th. The board initially implemented some defensive measures, but then last Thursday, they had to take him seriously when in an SEC filing it became clear that he had the funding in place, $46.5 billion, a mixture of investment banks and a $21 billion equity commitment from Elon himself. Now, his motivations are quite complex. He likes free speech and he sees that as a fundamental pillar of democracy. He's critical of censorship on the platform. He likes it to be polarizing. He's a polarizing character himself. And most simply, Francine, he wants to restore Twitter to its former glory. He has criticized accounts such as Barack Obama, who tweets infrequently, spam bots, accounts without proven identities behind them. He's emphatically against those. But all in all, Francine, it comes down to the fact that Elon Musk is a pragmatist. He already has over 80 million followers on the platform. And even though he has touted launching his own social media platform, perhaps he was dissuaded by former President Donald Trump's trust and thought it was a better option to simply take Twitter private.
All right, interesting. Laura, thanks so much. Laura Wright there with the very latest on Twitter. Now, for more on this developing story, let's bring in Bloomberg Quick Takes Alex Webb for more details on Twitter, and Bloomberg's auto czar Craig Trudell for the impact on Tesla. So thank you both for joining us. Alex, he's done it, $44 billion. Are we going to see Trump back? How will Twitter actually change?
It certainly looks from the tenor of his conversation that that is something that would happen. If he's in favor of free speech, maybe he does bring Trump back. The thing that's kind of curious, though, is he probably has a limited window to do exactly what he wants, because we are seeing regulations come in. Just last week, we saw some agreements in Europe about at a European level that there are going to be regulations which sort of control the sort of stuff you're allowed to post on social media. Similar stuff is in the works in the US. So absolute free speech is only to a certain extent within his power.
Yeah, I mean, the other thing is that actually the way he financed the deal, first of all, it was impossible for the board to refuse it just because they were getting so much money. The fiduciary interest means that they had to say yes, but he's financing it through Tesla. Is this bad news for Tesla?
It at least seems to be the case that, since his stake emerged, Tesla shares are down about 8%. So not by any means a sort of five-alarm fire, but we have seen the stock sort of soften a bit, even just in the last few days once it was clearer that he had some semblance of financing. But there is real risk in the idea that he's essentially borrowing against quite a lot of Tesla shares, so he's kind of levering up for this. The other question is how much stock he might have to sell to finance the equity portion, and whether or not he's able to sort of do what he wasn't able to do, what he tried with Tesla. He was trying to get public shareholders to sort of roll into the private company. If he can do that, maybe there's less financing that he needs equity-wise.
Great. Is this a vanity project? So he's probably not going to make money out of this, but is it a vanity project for him, or is it actually good for Tesla because it means that it's free advertising, and what do the rivals do? It's
interesting because he has said, clear cut, I don't care about the sort of economics of this deal, and he is not, he's sort of said he doesn't particularly care about Twitter making money, but certainly he's turned this into an incredibly valuable asset for Tesla in the sense that he's, used the platform to promote the company in a much cheaper way than we've seen auto companies spend, billions of dollars a year, advertising their models. He just does it all on Twitter, and it works out pretty nicely for him.
So, I mean, some people this morning have also funnily tweeted that they don't want to be part of this anymore because it could turn ugly. I mean, some of the things that he himself has posted, put some people off because of, the memes. Is there another social platform that people can go to? No.
Not really. We've seen this with Facebook over the years, that at various stages people get upset with Facebook and say, delete Facebook, quit Facebook. There's a mild outflow, but it's a tiny percentage. It's barely even a rounding error. It's worth remembering, of course, Twitter is a lot smaller than Facebook because it's got around 200 million active users. Facebook Meta across its various different products has close to 2 billion. I think, the product thing, one thing that is significant and people are maybe misconstruing is when it comes to verifying accounts, and that's, Elon says, about cracking down on spam bots. It's also really important for advertising because, if you can verify someone's profile, you know who is behind that profile. It is far easier to target adverts at them. And so there is a reason why some people don't like to verify their profiles, not just because they have, mendacious target or reasons for being on the platform, but also they don't want people to be able to tie up their ID with their Twitter and their Facebook and all their debt records and all these sort of things. That's a reason why people don't like it.
Craig, he also wanted this so badly. Is there a danger that he focuses on this for 80% of the time and actually, loses a bit of focus for Tesla?
That's a real concern too. I mean, obviously he's proven he has a track record of being able to multitask, not only, running Tesla and SpaceX, but digging tunnels with Boring Company and, working on brain implants with Neuralink. But there is a sort of question, right, of, is there a line at some point? Has he put too much on his plate? And, Tesla has proven it's been able to execute quite well the last few years, even with his sort of divided attention. But there's a question of, what happens if something goes awry with Tesla and his eye is essentially off the ball?
I mean, could anyone ban him if he went too far in tweeting?
Well, that's why it's interesting to see what regulations come out, right? Because, the SEC has only had limited success, but if it falls within the remit of someone else, it falls within the remit of the FCC, or rules come in at the US level which stipulate this is the sort of thing you can or can't post, then it's not going to be in his control necessarily.
All right. Thank you both for joining us. Alex Webb there from Bloomberg Quick Take and Bloomberg's Kartzar. He's Craig Trudell. Now, coming up, more from our conversation with the UBS chief executive, Ralph Hammers, as the Swiss bank rides a trading boom. And they're also paying their bankers quite a lot. This is Bloomberg.
The biggest second-round effect will continue to be a pressure on commodity prices, which will cause further inflation pressure, which may cause a further need for central banks to curb that inflation in order to manage either stagflation or possible even a recession.
Well, that was the UBS Chief Executive, Ralph Hammers. We'll hear more from our interview a little bit later this hour. Now let's discuss the latest market actions. Well, with us is Agnes Belesh. She is Chief European Strategist at Barings, and also joining us, Christine Aquino, Bloomberg's Markets Editor. So thank you both for joining us. First, PBOC, Christine, stepping in. All is good. They'll support the economy. Can markets actually go on a downturn tomorrow?
Well, Francine, it really depends on how they interpret these latest actions, right? I think the intended effect for the PBOC is that market sentiment improves as a result of their actions and investors feel safe enough to dip their toes back in. But I don't think investors are feeling exactly that. I think they're feeling exactly the opposite of that at the moment. They are really, really worried about what's going on in a macro picture in China, because we're not just talking about an economic slowdown and a little bit more negative economic data, but we're also talking about this widespread lockdown that could potentially have longer term effects and feed back into that data front that is already negative. And so I think at the moment, investors wondering how long this is going to last and whether the support will continue. I think at some point it will turn and they'll realize that the authorities are here to stay and keep supporting. But I don't think we're there yet.
Agnes, how much do you worry about earnings and how much do you worry actually about something going awry in China?
Yes, hello, good morning. It was always going to be impossible for China to leapfrog this pandemic and seal up its economy and then reappear on the other side intact. So in fact, I think in the short term, you're right, this will have an impact on earnings. I must say as well that during the pandemic, dependence on China came down simply because China was exporting more than it was importing. This dual circulation and common prosperity with a new rebalancing towards consumption actually was delayed simply because everybody was locked in and there was no spending going on, and exports were necessary for medical equipment and other cheap things that were needed in other advanced economies. So actually the world is depending a little bit less on China right now in the past 2 years, but for sure the idea that China, the global engine of growth of the world, is not going to be as strong as necessary as the rest of the world reopens is not nice. Nonetheless, we have to know that, like in the rest of the world, China will reopen. People will get vaccinated, and there will be a boost to growth later down the road.
Agnes, one of the other things that we're trying to figure out is, of course, when we'll see peak in U.S. 10-year yields. Is it this year? When does it happen? And what does it mean for the market you're watching?
Yeah, so I think this is the big question of the day, which is how are central banks thinking about it really, and are they really ready to engineer a recession just to kill inflation? And I think central banks are actually thinking about this quite differently from what markets are thinking. They know, maybe the Fed is completely different in that respect from the ECB, but they sort of know that this is a supply shock, and it feeds into a much bigger change in the world order, with a sort of deglobalization or relocation of supply chains closer and this green transition. So the shock to supply, to commodities, to materials, to metals is going to last for longer. So there's nothing they can do against this. In fact, you could think that central banks would welcome prices to go up as an adjuster to supply, so that more supply is incentivized to come up online. Otherwise, there's no solution to this. And it's not by reducing demand through a recession that anything of this will be resolved. So I think they're walking this thin line where they're trying to anchor inflation expectations and to speak tough and they walk the walk, but they will, and they talk the talk, but they will walk a little bit of the walk, not the full way. And so whatever is priced in right now is very unlikely to happen.
Christine, talk to us also about the banks. So we had earnings. Are they symptomatic of a wider picture for earnings overall in Europe?
Well, it is going to be interesting, Francine. I know that it is largely a positive first quarter for a lot of banks, and partly why European stocks, I think, are up today, because, of course, it is a bank-heavy region. Some of the key takeaways, very, very interesting. Obviously, the trading volatility and just a tumultuous quarter for markets in several measures, proving very well for banks. It was definitely a big boon for them in terms of just the amount of money changing hands and what that does to trading revenues. But then some of the more negative negative takeaways that I found, of course, some warnings on China and how that's going to affect a business moving forward. Of course, China, a very big market for a lot of these major banks. And I think also the idea of how much is already priced in. I think one of our guests earlier was talking about this idea of how much is priced into bank price shares at the moment, and whether this idea of higher rates, which is accepted as a particularly great headwind for banks, is that already priced in, and have we seen the best of the move now that it's all kind of nearly behind us, even if the actual rate hikes are still coming?
Agnes, what are you expecting from the ECB? And given some of the supply constraints and some of the supply chain issues, how do they walk that line? So
the ECB is, and it's interesting to say, is in a much easier situation than the Fed. There's no wage growth, and whatever demand there is not driven by credit. So the ECB doesn't have to cool off an overheating economy. In fact, the ECB is being helped by higher prices and the war in Ukraine, of course, and the higher cost of energy, which will by itself reduce demand. So the ECB, I think, wants to raise rates to zero. It would be just a nice thing to have. It would be sort of a normalization. But I don't think the ECB is thinking of going much further than that. And in fact, we know that it is readying any other tool it might need to restart asset purchases if things go wrong.
Thank you both for joining us. Agnes Belash, their Chief European Strategist at Barings, and Christina Aquino, our markets editor. Now, we're also getting a pre-market check on Twitter, the story in corporate news, without a doubt. So let's have a look if they're there. You can see pre-market, they're not moving by that much because they had actually a huge upswing yesterday. Coming up, Chinese markets breathe a sigh of relief after PBOC vows more support for the economy. We'll talk China next, and this is Bloomberg.
We did take some additional provisions in the quarter against the balance sheet that we have there. We took around $250 million of additional provisions for Russia exposures, and we do think that that's a fairly complete provision for everything that we can see at the moment. I think we're continuing with our long-term plans to grow our wealth franchise there. We see no reason to slow it down, despite some short-term dislocation because of the Omicron variant. But overall, we remain big China bulls. And when we talk about a China slowdown, we're still expecting to see growth rates of around 5% this year and next year, which is still very healthy compared to expectations in the West.
Basically, you booked $1.3 billion worth of Russia.
Well, that was the HSBC CFO, Ewan Stevenson, talking about the company's China company business after their first quarter earnings beat estimates. We'll share tradings lower this morning. Now, China's central bank has also pledged to support the economy through targeted financial for small businesses. It's also offering a quick resolution of the ongoing crackdown on technology firms in Beijing's latest bid to reassure the markets. Well, joining us now is Bloomberg's Asian health reporter, Rachel Chang. Rachel, good morning or good afternoon to you. Will Beijing go into lockdown like Shanghai?
Hi, good afternoon. Yeah, I mean, that is the biggest question I think markets are watching this week. You know, the situation in Beijing, not a lot of cases, only about 20 cases a day. But we do know that what the Chinese government has taken away from the crisis in Shanghai, which has become such an embarrassing, global headlines type of story, what their takeaway is not that COVID zero doesn't work. It's that they need to do COVID zero even harder, even stronger, even earlier in an outbreak. So you see Shenzhen, for example, they locked down over 80 cases, and that was done in a week. So it's highly possible that Beijing would go this way. However, it is the most important city in China. It's extremely politically important. All the elites are there. So it would be a massive loss of face as well to lock down Beijing.
Rachel, why is China still doing the COVID zero strategy?
I think that is a question that the global markets are asking. But what we do know is that for President Xi Jinping, COVID zero is now an ideology. It goes beyond economic growth. It goes beyond other sorts of priorities that the government has. And we do know that China is right now politically waiting for the Party Congress in November, which is when Xi Jinping will try to get what we think will be a third term, potentially indefinitely as well. And we know about this political structure that they have, that stability, and calm, no massive changes, no U-turns before these sorts of big political moments are essential for their structure. So that is why investors and analysts don't expect to see any change this year.
Rachel, what exactly, once PBOC does what they've promised, is there anything more that they can do?
I think there is a lot more that they can do. I mean, the problem is whether or not markets really believe that, what their stimulus and what their support will do will help or will stem the damage that the overall virus policy will infringe on China. And the problem is nobody really knows how bad this can get. We know that China is such an important part of the world economy. The global supply chain relies so much on it. Even lockdowns in smaller places, for example, Inner Mongolia, that's a rare earth production hub. So we really don't know how far that damage can be, and that is why markets so far have pretty much shrugged off the sort of promises and the pledges from the Chinese central bank to support the economy.
All right, Rachel, thanks so much. Rachel Chang there with a great update, of course, on China. Coming up, Lavrov's warning. Russia's foreign minister says there's a serious danger of nuclear conflict. We'll dig into all of the latest on Ukraine next. This is Bloomberg. Sealing the deal, Elon Musk wins Twitter for $44 billion, while the tech giant's shares jump. European banks kick off the reporting season. HSBC and UBS beat on profit despite the war in Ukraine. Plus, to the rescue, the PBOC pledges to boost support for China's economy as virus testing is expanded to most of Beijing. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first thing is first, let's get onto the markets because they seem to like what we heard from PBOC, that they will stand firm and they won't calm markets. So actually, just the fact that PBOC has promised that, they haven't intervened yet, but we saw a big reversal when it comes to these European stocks. Yesterday they were down, and today we're seeing a risk-on mood. In fact, European stocks are rising from a 6-week low after China's central bank pledged to support the economy. We also have a lot of earnings that came in better than expected. I have to say, yesterday there was risk appetite being weighed by concerns over a more aggressive U.S. Federal Reserve rate outlook and the spread of COVID-19 in China. So once again, just a reminder that things on the markets can turn pretty quickly both ways. Now let's get the latest on the war in Ukraine. And the Russian Foreign Minister Sergei Lavrov has warned there's a serious danger of nuclear conflict. Now it comes as U.S. Defense Secretary Lloyd Austin said Washington's goal was to see Moscow weakened so it cannot attempt a repeat of the war. Well, joining us now is Tim Adams. He's Chief Executive Officer of the Institute of International Finance. Tim, as always, thank you so much. So nice to speak to you in the studio.
Good to see you, Francine. Thanks for having me back.
Yeah, it's nice to have you back in London. So I'm not going to ask you about nuclear war because, of course, you can't price that and you have no idea what it means for banks. But we're still looking at sanctions. These sanctions could be increased. We could see an oil embargo.
Right.
How are banks doing?
Banks are doing well. You know, we've been watching this crisis pretty closely. They're in constant contact. I saw HSBC, Santander, and UBS this morning. Good news. Ralph Hammers did a nice job. Anna Botín does a nice job as well. And there's something to be said for large, diversified institutions, right? But obviously, we're watching Ukraine, the potential spillover effect. I think more sanctions are coming. I think oil and gas are going to be central to that. We just don't know the details yet.
Tim, do you have a good reading of actually how difficult it has been for these banks to look at sanctions, but also to understand? I was having a conversation actually with a senior banker who was saying, you can't sanction someone just because of a nationality. And sometimes they have a holdings where they don't exactly know where the money is.
No, that's correct. This is incredibly complex. There's so many shell companies around the world. There's issues of beneficial ownership. We're not actually sure who actually owns some of these assets or where they're located. So kudos actually to the U.S. and the U.K. and to EU to search for and identify these assets. And, the sanctions riders are working overtime, and we're scrambling to keep up.
Is there any, I don't know if something that you look at, we heard from the ECB a couple of weeks ago that actually cryptocurrency in certain cases has been, could have been used, but then there was also pushback against that actually that's not really the case because it could be, a common person doing that transaction.
It's not really a case, and it actually is being used for humanitarian purposes in Ukraine.
As well.
But there's just not the liquidity, and we just haven't seen it. We actually, there is the capacity to peer into a lot of this transactions, and I don't think it's being used to subvert sanctions.
Tim, overall, what are your bank's members worried about? So, we had a stellar performance, especially during the pandemic, from a lot of the Wall Street banks. Now they're kind of regrouping. They're not doing as bad, but it's not the stellar returns that we saw back then. Are investors now too used to that?
Well, we're getting costs under control. Look, there's a lot of technology spend out there. You see JPM spending $15 billion a year. You got cyber resiliency, which is important. You got technology spend just to continue to offer the kinds of products and services that consumers want. So it's really getting expenditures under control and really dealing with the rising rate environment. Not a surprise, but there's a huge dispersion of rate trajectories around the world.
Yeah, not a surprise, but sometimes it feels like it is a surprise to the markets.
Right.
Is it because we haven't really quite figured out? I mean, we haven't really been in an inflationary environment for, what, 2 decades?
Right. Right. If you walk around the trading floors of a lot of these places, most of those people on the trading floors have never seen an inflationary environment like this. So it's really new for people, and we've forgotten it. I lived through the 70s. I remember what it looks like. A lot of people haven't.
Yeah, I mean, I felt very rich as a child because I'm Italian, and we had the lira that, it was like 10,000 liras was worth like $1 or something at the time. So I've also lived through inflation. Is there a risk of policy mistake? And what do big chief executives can do to actually protect themselves against some kind of monetary policy mistake?
Sure, I think there's a concern about a hard landing in the United States. How fast and how furious will Jay Powell be? He indicated last week they're going to move quickly. Pulling this off with a soft landing will be hard. Not impossible, but hard. ECB is somewhere else. Obviously, there's enormous uncertainty with the periphery of Europe and what European growth is going to look like.
And what does these banks look like in terms of GVs with China? We heard, again, even if you look at UBS, which you were just talking about, the wealth management business in Asia has been underperforming.
Yeah, it was. I think you heard HSBC this morning. Their medium long-term view is still very bullish. The short term, there's so much uncertainty coming out of China. Still a COVID lockdown. There's still the issues of monetary policy. What exactly is the PBOC going to do? You've got issues of technology policy, real estate. So, it's a big year for China, but I don't think we're going to see much on the upside this year.
And so it doesn't mean, are your members looking at doing more business in China? Do they approach it much more cautiously? Also because we don't really know the relationship between Russia and China at the moment.
Sure, you can't afford not to be there, and they've invested decades of showing up and investing and building their business. Brands and the market share is still pretty small. You heard that on HSBC this morning. But I think there's still ambitions to do more. There's a huge market. You just have to take a long-term view and be cautious.
I always enjoy our conversations because it's also a good idea to take stock on where we are in terms of some of these, the financial sector as a whole. How do you think the pandemic has changed them? So we're looking at maybe working from home more. I know you're here in London. You also spoke on an ESG panel. Is that taking a back step?
Well, it's still important, but obviously the daily headlines have eclipsed the issues of climate, but still important. I was just in New York last week, and you're hearing from at least the New York firms an effort to really get their workers back. But there's a resistance among Gen Zers and others. They want to work from home, or they want a much more liberalized working conditions. So we just need to find a balance.
Tim, we're just getting some breaking news, and actually I'd quite like to get your thought on this. This is the SEC chief, Gary Gensler, wanting to slash the amount of time that traders have to report many bond transactions as part of a bid to increase visibility into fixed income markets. So this just breaking on the Bloomberg terminal. I think he's actually delivering these remarks at the same event that you were. This is like City Week, so it's almost like we planned this. I mean, this is a pretty big, market-moving event, the fact that he's slashing bond trading reporting time to 1 minute. Are we going to see a lot more transparency for some of these transactions?
I think you're going to see a lot more from Gary Gensler. He's very ambitious, he's very smart, and he's determined that the SEC is going to be a leading policymaker in Washington. And I think that's why you're seeing other agencies scrambling to keep up with Gary.
So, other potential measures, and he's also weighed in on cryptocurrencies, like other potential measures, and this is something that we were talking about a little bit earlier. Some of these potential measures to boost transparency could include making a public trace date on individual treasury transactions. This is something that he's reported in the past, but also looking at some of the trading protocols and fees paid for a transaction. I mean, is this an earthquake actually for your industry if he gets his way?
Well, I haven't seen the details, so I don't want to speculate. But he certainly has made transparency and disclosure an important part of an anchor of his leadership, and I think we're going to see more of that. Obviously, with respect to climate disclosure, there's the issue of the SEC versus the new ISSB. So Gary's aggressive, very smart, and is going to be a part of the policy discussion for the foreseeable future.
In terms of ESG disclosures, are we going to have a common ground worldwide? And if we don't, how difficult is it actually going to be for investors to make up their mind on where where they put their money.
That would be ideal, but no, we're not going to have a common ground. Right now, we have 24 different taxonomy regimes around the world. We don't need 24. We need at least 2 or 3, ideally 1. We're not going to get there. It will be the SEC versus the ISSB on things like materiality.
Tim, thank you so much. Tim Adams there, the Chief Executive of the Institute of International Finance. Also commenting on that breaking news just moments ago, the SEC Chief, Gary Gensler, saying that he is looking at slashing bond trading reporting time to 1 minute. This is huge for Wall Street. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's expanding its COVID-19 testing to most of Beijing, raising fears for an unprecedented lockdown in the city. Nearly 20 million people will undergo 3 rounds of COVID testing over the next week or so. The expanded program is causing jitters in the capital about further restrictions. Currently, more than 50 million people in China are under lockdown. Now, President Joe Biden has named career diplomat Bridget Brink to be his new ambassador to Ukraine as the U.S. ramps up its military aid and diplomatic presence in the country. Russian Foreign Minister Sergei Lavrov, meanwhile, told local TV there is a serious danger of nuclear conflict, which should not be underestimated. Moscow's attacks have continued on a steel plant in the port city of Mariupol, where some 2,000 Ukrainian fighters are currently holding out. Sweden and Finland are reported to have agreed to seek entry into NATO in mid-May. According to media reports in both countries, the 2 governments plan to publish their applications to join the defense bloc at the same time. Russia's attack on Ukraine has led to a radical rethinking of the security environment in both of those countries. And a new study says Brexit caused UK imports from the European Union to collapse and led many small British firms to give up exporting to the EU altogether. After analysing the first year of the new trade deal, researchers from the London School of Economics found the value of imports from the bloc fell by 25% relative to imports from the rest of the world. The number of British export relationships with EU companies dropped by 30%. The study stripped out distortions caused by COVID. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, it's official. Elon Musk has agreed to buy Twitter for $44 billion. The world's richest man will soon be in charge of one of the most influential social networks in the world. We'll bring you all the details next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn back our attention to our top story. A month ago, Elon Musk's main connection to the social media platform Twitter was as a prolific user. From there, he outed himself as Twitter's largest shareholder before becoming a short-lived prospective board member, a hostile suitor, and finally a successful deal maker, tweeting dozens of times along the way. Well, joining us now is Hussein Kanji, his partner at Hawkstown Ventures. Hussein, we're a little bit obsessed with this story because we don't know how exactly, what this means for Tesla, how he funds it. We know how he funds it, but this margin loan, what it means, but also what does Twitter become?
I mean, that's the big, I think, open kind of multi-million-dollar question now that he's buying the thing. No one really knows what he's going to do with it. I think, there's not much to lose as a company from a Twitter perspective because it's got to change. When you compare it against its peers in other advertising-oriented businesses, Twitter brings home about $5 billion of revenue. Facebook brings in about $117 billion of revenue. Google brings in $257 billion of revenue. So there's quite a bit of a difference between Twitter's audience and Google and Facebook's audience, which translates directly into the revenue side. This probably is the biggest thing to change, but the question is how and when and the mechanics. No one really knows.
What do you think, Hussein? I mean, do you think he wants to make money out of this? He's saying he's not, but what is this, advertising? And I guess, is there a danger that regulators, step in? Because at the moment, if he's in charge, then he can't even ban himself no matter what he says on the platform.
Yeah, I mean, I think this is almost as much about free speech and about a platform for Elon, but I think he's a good businessman. So I think this is about turning this into a more valuable business. There are a bunch of ideas that have been floated around the internet on this. One of them is to split the Twitter business into two things. One of them is the social graph or the user graph, the actual core content. And the other one is the advertising business. And by doing that, you might be able to innovate a little bit easier. One of the challenges of being a public company is you're very much in the limelight of your public market investors, and you have to deliver quarter on quarter. If you're a private company, you might be able to experiment. There is an argument that Twitter may have gone public a little bit too soon, and it should have actually experimented a little bit more. And the public markets don't give the Twitter management team a very long leash to actually experiment. A privatized Twitter could actually go out and experiment.
But Hussein, what kind of experiments would you put in place? I mean, we sat down and you said, look, it's not doing as well as some of the other social media platforms, but it's a different proposition. It doesn't speak to the same kind, I guess. It's just not the same way of sharing that you do on other platforms.
Yeah, so one of the big ideas that's been floated around on the internet by a fellow named Ben Thompson, who runs a firm called Strategery, is you split it up and you open up the Twitter client base. So back in 2013, Twitter famously shut down most of the clients that were out there. So you could access Twitter via other companies other than Twitter. And there was quite a bit of innovation as to how you actually present the information, how you consume it. The graph stayed the same, but the client basically changed. Twitter shut all of that down because there was another fellow, Bill Groth, who tried to make a run on Twitter by buying up all the Twitter clients and then effectively trying to control Twitter. There's been a bit of stagnation in kind of how you use Twitter. It's kind of been the same ever since, for the last 10 years. And there's probably a little bit more innovation that you can have. Again, the challenge for that is that's probably not going to drive any short-term revenue. And it means you probably need to be a private market company to figure that stuff out.
But you also need to be very controversial, which Elon Musk is no stranger to be able to attract new consumers to the platform. And then will the regulators crack down on that?
Yeah, so I think if you're talking about just the content that people are producing, yeah, I mean, I think that the more audacious the content is, I think the more of a following, there's a lot of readers, right? So it's almost like the Daily Mail problem. If you publish things that are outrageous, you get a much bigger audience. And the Daily Mail is one of the largest media companies for that reason. And that will certainly invite the regulators. But I'm just thinking more from a technology and business perspective. Even if you have an audience of people who say salacious things on Twitter, turning this into a good business and turning this into a more vibrant business is very much of an open question. I mean, all of us in media, I think, use Twitter very actively, but the mainstream doesn't really use the service nearly as much. I mean, Donald Trump kind of maybe made it famous by being a president who tweeted, but the average person probably doesn't log on to Twitter, and I think those numbers are very much reflected in the advertising revenues that you see for the companies.
Salacious is such a good word, Hussein. Talk to me a little bit about the repercussions this has on Tesla. So there's a big margin loan also attached to Tesla. So if there's a breach of the covenants of the loan, actually you sell off Tesla shares. Is this a concern? Tesla is a huge, also other tech company.
Yeah, a huge company, also very highly valued, and I think Elon is effectively borrowing with the wealth from that he's created from Tesla. But Tesla itself is a pretty highly valued company. I assume that the Morgan Stanley advisors who've been advising him have figured out how to be able to structure this so that he's not in any kind of personal liability or doesn't put Tesla into any jeopardy. But there's so many questions with this acquisition, right? Even the poison pill, which Twitter put up, it's very strange for a company that says, I don't want to be acquired, a week later or less than a week later concede and say, yeah, we're very happy with the acquisition. There's so many questions with this transaction, like why does he want it? What's he going to do with it? How's he going to finance it? And why did the Twitter team all of a sudden change its mind so dramatically in a very short amount of time to say this is actually the right thing for everybody?
All right, Hussein, thanks so much for all of the insight. Hussein Kanji, their partner at Hoxton Ventures. Now, coming up, Lavrov's warning. Russia's foreign minister says there's a serious danger of nuclear conflict. We'll dig into the very latest on Ukraine. That's coming up next, and this is Bloomberg.
The biggest second round effect will continue to be a pressure on commodity prices, which will cause further inflation pressure, which may cause a further need for central banks to curb that inflation in order to manage either stagflation or possible even a recession.
Well, that was the UBS chief executive, Ralph Hammers. Now let's get the latest on the war in Ukraine. The Russian foreign minister, Sergei Lavrov, has warned there's a serious danger of nuclear conflict. It comes as U.S. Defense Secretary Lloyd Austin said Washington's goal was to see Moscow weakened so it cannot attempt a repeat of the war. Well, joining us now is our senior reporter for international affairs, Mark Champion. Mark, good morning to you. So are we seeing potential escalation here in terms of a more direct conflict between Russia and NATO?
Well, we're sort of edging in that direction. I mean, you have the Americans saying publicly what perhaps they've been talking about behind the scenes for some time, but that is that part of their goal here will be to degrade the Russian military just so that they just aren't capable of performing this kind of operation again, whether it's in Ukraine or elsewhere. And that's something they have not been talked about in public before. So, that is a significant step, and in this case seems to have been taken quite deliberately. And then on the other side, you have the Russians again talking up the nuclear threat. Lavrov saying that this is serious and it needs to be taken seriously. And ultimately, that is the final tool that the Russians have to ensure they aren't defeated in any conflict, which they increasingly say is one not between them and Ukraine, but one between them and NATO, with Ukraine as the proxy. And Russia has long had and been very well aware that it has a conventional weapons deficit relative to NATO. It could not win in a conflict with NATO directly, and therefore it relies on its nuclear deterrent.
So, Mark, there were also missile attacks on railways across western and central Ukraine. What does that signal in terms of a change in tactics?
Well, it's essentially you have this build-up and a long front in the east now with a new kind of campaign there, and both sides trying to supply it as fast as they can. So it's critical to the Ukrainians to get the weapons that the Americans and others have promised, the artillery, the tanks, the APCs, all this kind of stuff, the heavy weaponry to fight that kind of campaign, to get it the 1,300 kilometers all the way across from the Polish border or the Slovakian border to the Eastern Front. And the Russians are fully aware of that. And what they're hitting is the transport links, the storage dumps where they think this equipment is being moved, and trying to hit them so that it never reaches the east.
Mark, thank you so much. Mark Champion there with the very latest, of course, on this situation, what that could mean, given the rhetoric seems to be amping up. That was, of course, with Mr. Lavrov a short while ago. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz will be in New York. Anna Edwards will be in London. This is a picture for European stocks. So we were seeing a nice little rebound since yesterday. The earnings are rolling in. European stocks are actually climbing after China's pledge to boost monetary policy support for its COVID-hit economy lifted sentiment. Traders across the board also eyeing a raft of earnings reports from some of the region's biggest company. Now, aside from vowing more assistance, there's a lot that we should talk about when it comes to BBOC, also saying it will promote healthy and stable development in financial markets. Most of Beijing is being tested for the virus, and that's really fanning fears of an unprecedented lockdown there. If you look at U.S. corporate earnings, they're also providing a bit of lift to some of the equity bulls. Close to 80% of firms have beaten profit expectations. This is Bloomberg.
As with everything in markets this year, we have to be very careful.
It's been a pretty volatile year, and recalibration, I think, really is the right word.
Slowdown in growth is going to be very, very impactful, especially a country like China.
If we have a slowdown in China, it's definitely bad news for us.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, April 26th. Our top stories today. It's Beijing's latest bid to reassure investors. China's central bank pledges to help small businesses and quickly resolve the crackdown on the tech industry. Russia warns there's a real risk of nuclear war. The Russian foreign minister says it can't be underestimated. Meanwhile, he says peace talks with Ukraine will continue. And a big week for earnings. We've heard how European banks, UBS and HSBC, are navigating the market turmoil. And now that the Twitter deal is done, we will hear from Apple, Amazon, Alphabet and others in tech this week. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kailey, European equity markets doing their best to look on the bright side, but looking at US futures, you wonder how long that lasts.
Yeah, and they tried to look on the bright side as well in Asia overnight, so we'll see if the U.S. can follow through with that once the opening bell rings in about 4.5 hours' time here in the States, Anna. As for that picture in Asia, you did see the MSCI Asia Pacific Index up for the first day in 4, higher by just about 0.25%. Of course, as you alluded to, Anna, PBOC coming out, pledging support on the monetary policy front for a Chinese economy that really is grappling with the zero COVID policy, promising to end the technology crackdown relatively soon. So you did see that reflected in Chinese tech stocks. The Hang Seng Tech Index was up nearly 3% overnight, but not a lot of positive read-through to Chinese equities. Yes, we didn't see losses at the scale. We saw them in the Monday session, but still that benchmark CSI 300 down about 0.8%. And of course, you did already see action yesterday on the Forex reserve ratio being cut by a percentage point, trying to stabilize the Chinese yuan a bit, but it remains right around its weakest level against the US dollar going back to November of 2020, trading at 656.65. Kriti.
Yeah, Kailey, and it's really that story that's getting kind of read through into the U.S. session. Remember, it comes down to the growth scare, specifically the COVID lockdowns in China that you were just mentioning. Futures down just marginally, down about 0.1%. But I think the real story here is going to happen in crude, and that's down 1.2% when you look at NYMEX crude futures. This is really important because this is no longer a supply chain story, an inflation story. It comes down to a fundamental growth and demand story, and that's really what's kind of weighing. But remember, anything can happen in a couple of hours. We are still expecting tech earnings after the bell today, which could really make or break the case for stocks and for risk assets broadly. But speaking of risk assets, we have to hit that 10-year yield because once again, you can see a bid into treasuries, which in the face of this inflationary hawkish environment is kind of strange. But once again, it really speaks to those demand fears. That being said, Bitcoin, another risk asset, up about 0.8%. This is really important because if Bitcoin is your risk asset and showing you that there is a little bit of a bid, will futures catch up closer and closer to the open, Anna?
Yeah, Kriti, we are seeing a little bit of that bid for risk assets here in the European space. And I wonder with hindsight how we will look back on yesterday and analyse, evaluate how significant it was, because it was a real marked different session, wasn't it, to the week before where we were very preoccupied by inflation. Yesterday, it was the turn of growth to be back centre stage, Chinese growth in particular. And today, we're still wrestling with those themes and trying to work out which comes out on top, I suppose. But this is what we have for European equity markets. Whilst we wrestle with the themes, European equity markets looking to catch up with some of the late day rally in the United States yesterday. Was that driven by M&A around tech names? Was that driven by some of the comfort coming from China overnight? But we are seeing a little bit of movement higher on those European stocks. And in fact, nearly all sectors across Europe in positive territory, even if not by much. Brent crude, Kriti mentioned what's going on with WTI, and we are seeing a little bit of a move lower on the Brent crude price, 101.40, not by the scale that we saw yesterday. We saw a number of percentage points taken off the crude price yesterday, but we do watch that for clues on growth. We also watch the euro. Are both of these really caught up with the Chinese growth narrative? Because the euro under pressure with a stronger dollar, the euro down by 0.25%. A banking focus for you here in terms of stocks to talk about here in Europe. We have UBS moving higher by just over 2%. And the focus really there on investment banking and the returns that traders can deliver through their trading activity rather than the wealth management side of things, which struggled a little more. HSBC down by 3.5%. They've had to acknowledge that the state of the balance sheet, the capital ratios they report mean that there's a little bit less likely chance of returning cash to shareholders in buybacks, and so that weighs on the stock. A look at Russian assets for you. Of course, our headlines talking ominously about those headlines from Sergei Lavrov, the foreign minister, those lines from him talking about the risk of nuclear war. We, of course, consider that. Worth noting that we are seeing the ruble bouncing back a little bit this in recent sessions, and in fact, as we work towards, so this from a strictly markets perspective, and this market pretty broken, as we heard from one reporter from Blue Bay, or one guest from Blue Bloomberg just in the last week or so. We are working towards a central bank meeting, Russian central bank meeting on Friday, and then there is an expectation of interest rate hikes there, Kailey.
Yeah, and we absolutely will be watching for that later on this week. As for what we're watching on this Tuesday and taking a look at the day ahead, of course, earnings will continue to roll out. Microsoft and Google's parent Alphabet will be among the big tech names set to report. Then UN Secretary General Antonio Guterres visits Moscow, where he will be meeting with President Putin and Foreign Minister Sergei Lavrov. And finally, economic data as well. The U.S. will release data on new home sales and durable goods orders, Anna.
Now, Kailey, in China, the government's taking more steps to reassure investors nervous about growth and COVID lockdowns. The central bank pledged to support the economy through targeted financing for small businesses. Plus, it promised a quick resolution of the ongoing crackdown on technology firms. Let's get more from Bloomberg's Tom McKenzie, who joins me on set and has been watching this story in depth, of course, Tom. Worth noting that Chinese stocks ended the day in negative territory. So if there was any sense that this was to persuade a different risk appetite, that didn't work. But what did we hear?
Yeah, because the fly in the ointment is that we've heard these kind of comments before from Chinese officials. They're repeating a lot of the similar lines that we've heard in the last few weeks and months. As you say, just to recap some of the key elements that came out from this PBOC statement, so that support for small businesses, support for sectors that have been particularly badly hurt as a result of the pandemic, so coal and aviation, and then pledging to wrap up in pretty quick fashion that crackdown on technology. But again, reiterating lines that we heard before. So investors and economists saying there needs to be more in terms of the policy response from Beijing, particularly at a time when you're seeing mass testing of almost 20 million people in the Chinese capital, which is on the brink, teetering on the brink of a potential lockdown. So we continue to look and watch the COVID numbers out of Beijing and to what extent those lead to potentially a wider lockdown across the capital. And we're watching as well the Politburo meeting, which is taking place in the Chinese capital, the senior leadership of the Communist Party, whether they bring out the big bazooka to really support an economy that is under pressure, not just as a result of being hamstrung by COVID-0, but also the self-inflicted wounds, arguably, of the crackdown on the real estate sector and the technology sector. And that really is putting in jeopardy this 5.5% GDP growth target that they have set themselves for this year.
Yeah, how achievable is that really? Thank you so much to Bloomberg's Tom McKenzie. While we continue to focus on the situation in Beijing, we also continue to focus on the war in Eastern Europe. Let's get to the latest on Ukraine. Russian Foreign Minister Sergei Lavrov has suggested that talks with the U.S. could be useful as United Nations Secretary General Antonio Guterres continues diplomatic efforts to end the war with a trip to Moscow today. This comes after Lavrov warned that there is a serious danger of nuclear conflict. Joe Matthew, Bloomberg Washington correspondent, joins us now in D.C. Joe, we've heard the Biden administration warn of severe consequences should Russia use unconventional weapons, chemical, biological. What about if Russia actually resorts to nuclear weapons in this war?
Well, that's the big question right now. I'm not sure the White House has that answer. It's certainly not giving it publicly, as we have all pressed the administration to understand what exactly severe consequences might mean. In this case, though, striking comments again from the foreign minister in Russia, and not the first time. Vladimir Putin himself made a similar suggestion a few weeks ago, and we tend to hear this refrain when Russia is on its heels, or at least feels like it is and has been for the balance of this war. Over the weekend, of course, we saw the visit of the Secretaries of State and Defense in Kyiv. The optics there projecting American power and solidarity with our NATO allies, clearly not the vision that Vladimir Putin wanted to see here. And that has prompted a bit of this talk here to suggest, though, that negotiations are useful and that the U.S. is somehow blocking negotiations, as Sergei Lavrov has said, is curious after Putin himself, Kailey, just a couple of weeks ago said that talks had reached a dead end. We'll see how that plays after the Guterres visit today.
Joe, Congress is back in session. We know that there's already a military assistance package in the works, but potentially food aid on top of that. What would that look like?
Yeah. It's a great question. We're really waiting for a number at this point, Creedy. We heard last week from the president that he would make a supplemental budget request for military funding to have an uninterrupted flow of weapons. But you're right, when you add the humanitarian aspect here, we're talking billions. It will likely be a good $5 billion, according to some of the talk that's coming from the White House, which would match similar spending that we've made so far with Ukraine, a little bit more, in fact. But the idea is to not have to keep going back to the well and asking for more money every month as weapons and humanitarian relief are drawn down. It is likely we'll get a number here by the end of the week. And this could be one of the most bipartisan issues in Washington right now, as lawmakers on both sides of the aisle suggest that they will pass whatever they're asked for.
Joe, thank you very much. Bloomberg's Joe Matthew. You can listen to Joe every weekday on his radio program Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now, European bank earnings kicked off this morning with UBS, HSBC and Santander all reporting numbers. We spoke to executives from all banks this morning.
We are a commercial bank, highly geared towards higher rates. So, we are quite optimistic even, beyond 22, 23, 24. On the back of these much higher rates.
We did take some additional provisions in the quarter against the balance sheet that we have there. We took around $250 million of additional provisions for Russia exposures, and we do think that that's a fairly complete provision for everything that we can see at the moment.
The biggest second round effect will continue to be a pressure on commodity prices, which will cause further inflation pressure, which may cause a further need for central banks to curb that inflation.
Let's get more on UBS with Bloomberg's Manus Cranney, who was in conversation there with the CEO, Ralph Hamers, and he joins us now from Zurich. A couple of, lots of different sort of news flow coming through from the UBS numbers, but the contrast between investment banking and wealth management, one of them.
It just wasn't supposed to be this way, was it? The investment bank was never supposed to be the bulwark to your wealth management business, but it was. $900 million worth, let's say, of revenue at the investment bank, Anna. That's 30% more than the market had anticipated. It was an extraordinary quarter, in the words of UBS, and it was the best quarterly performance since 2007. It's a question of balance. The investment bank balanced the wealth management, transactions down by nearly 20%. And it was the flow show at the investment bank in the FX and the rates business and the equity business, but more so FX, that balanced against that drop in the wealth management. And it was Asia down, USA up. So for me, it's very much three sets of checks and balances that we come out here with the best quarter since 2007. The money flowed in and $19 billion of net new fee-generating income. If the alpha was buybacks in the first quarter, I'm struggling to see where the beta is going into the back half of the year. The headwinds are there from China, Ukraine, and indeed an overall risk from a rate shock in the USA. Anna.
Yep, a lot that these banks are facing. Thank you so much to Bloomberg's Manus Cranney. Now that's what's going on with European corporates. Let's talk about U.S. corporates as well, because Elon Musk and Twitter reached an agreement for him to buy the social networking platform for $44 billion. But there is a lack of details on how exactly he will fund it. Let's get to Bloomberg's Laura Wright with more. So Laura, he has to come up with $21 billion. How's he going to do it?
Well, he's likely to bring in a new equity partner or leverage the limited existing shareholders. Kailey, we can see in the pre-market that Twitter is still trading below that magic number, $54.20. That's what the shareholders will receive. And that offer represents almost a 40% premium to where the platform was trading all the way back on April the 1st, the last day before we learned that Elon had become involved in the company. Now, if we dig a little bit deeper into the funding, as you say, Apollo Global Management, one private equity firm who has been associated as part of the deal potentially with Bloomberg, if he does keep on board some of those existing shareholders, Jack Dorsey, Twitter's founder, still has a $1 billion stake. Now, there is the critical question, is he going to sell some of his Tesla stock? He's got over $200 billion of wealth tied up in the electric vehicle company. But as we discussed last week, if he is to do so, that would send really a negative signal to the existing shareholders. It implies less upside to the share price. And we know that Elon loves his cryptocurrencies, Bitcoin, Ether, and yes, the Shiba Inu, Dogecoin. Bitcoin has risen over 700% since March of 2020. So that should help if he were to sell down some of his crypto, support this deal.
Laura, Twitter, Tesla, not the only tech names in the spotlight this week. Of course, we know this is also a big week for tech earnings, essentially the week that could make or break the market. Microsoft and Alphabet reporting after the bell. What can we expect?
Well, look, to start broadly, Kriti, we are seeing a number of headwinds in the sector. Rising yields, 50 basis point hikes from the Federal Reserve priced in. Consumer confidence has been dampened because of rising inflation, supply chain concerns for companies like Apple due to the war in Ukraine and COVID lockdowns in China. But from Microsoft, the focus is not only going to be on the Activision Blizzard offer, but also the cloud, intelligent cloud revenue expected to grow by 25%. And it's the cloud, remember, that allows the instant functionality of Office 365. For Alphabet, another cloud player, but Alphabet, interestingly, less impacted by those Apple privacy changes, which were a negative for a company like Meta Platforms, and it means that they can still generate that appealing advertising revenue.
All right, Bloomberg's Laura Wright, thank you so much. Both of those stocks relatively unchanged in pre-market trading at this point. But there are some other stocks that are moving in more dramatic fashion in early hours here in the U.S. One of them relating back to that Twitter story that Laura was just talking to us about. Digital World Acquisition Corp. This is the SPAC that plans to take Donald Trump, the former president's media company, public. It was down about 13% yesterday on news that Musk and Twitter had finally inked that deal. Concerned that maybe Donald Trump was just going to go back to that platform if it was Elon Musk in charge. But Fox reporting that he has no plans to do so. So as a result, a little bit of a rebound for those shares, up about 6% in early hours. Another social media stock, though, is a little bit lower before the bell. That would be Meta Platforms, which of course operates Facebook. It will be reporting tomorrow. Ahead of those results, though, it's down about a tenth in early hours on this Tuesday. Also lower, a lot of the energy complex. Oil is down for a third day, coming back to those concerns about the demand picture in China. That is weighing on ExxonMobil, already down about 6.5% in the last 3 sessions, now looking potentially at a fourth day of losses, down a little more than 1% before the bell, Anna.
Kailey, coming up on the program, Marija Veitmane joins us, senior multi-asset strategist at State Street. We will talk about the markets, about how earnings can or maybe can't take on our worries about higher interest rates and stuttering Chinese growth. We'll also talk to Bruce Carnegie-Brown, Lloyd's of London chairman. Lots to discuss with him when it comes to the war and its links with the insurance sector. Plus, don't miss Bloomberg Crypto today at 1 p.m. New York time, 6 p.m. in London. Today, we'll be hearing from Ripple CEO Brad Garlinghouse. We'll also hear from Kathy Kraninger, former director of the Consumer Financial Protection Bureau. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. One of the big topics this morning and arguably this entire week is going to be the growth story. And what better way to look at that than through the oil market, specifically Brent time spreads. Now stick with me, it gets a little nerdy here. When you kind of trade oil, you tend to trade a premium in the first month contract to the second month contract. Essentially, it means that the need for oil, the demand, the growth, it's in the here and the now. When that time spread compresses, when that premium gets smaller and smaller, it's kind of a signal that perhaps growth is slowing. Perhaps that need for oil, that need for growth, it isn't that immediate. And that's a concern for markets across the board. And you're already seeing that in oil futures really dropping. This coming off of course, the COVID scare in China. And you can really see that for our TV audience, that premium closing. For our radio audience, just take my word for it. You're starting to see that extra kind of premium that you pay for the extra first month contract starting to decline. What does this mean for growth, not just in China, but for across the world? Can one region drag the entire global economy with it? Let's ask Ben Ram, the Bloomberg cross-asset strategist and also contributor to the Markets Live blog. He joins us now. Ben, how do you square this with the supply chain pressures?
Morning, Kriti. I do think that in the short term, the concerns about China are going to sap demand, and therefore crude oil is down. But if you look at the longer term trajectory, I do think that what we saw in the markets yesterday was a one-day reaction, because at the moment it's the supply side of it, that's the supply bottlenecks that are going to be the focus of the markets. There is no case for a recession led by a slowing demand in China anytime in the near future in the US economy. I don't think we are still going to expect above trend growth in the US. So I do think that the narrative here is one of supply bottlenecks leading to spiraling inflation, and that is still the predominant story.
Okay, so that means then, good morning, Ben, that means you think that treasury markets in the US should go back to focusing on inflation and not be distracted by weakness in Chinese growth?
Absolutely, and we are already seeing that, Anna. We do think that the 10-year yield has a lot more to rise, and you will see that happening as we get closer and closer to the Fed May meeting, and also this week's PCE data. If you look at the 2-year, we have done about almost 200 basis points this year. And that's pricing in a lot of hikes. And the markets are at the moment factoring in 10 rate hikes from the Fed. I'm not too sure all of that will fructify, but the bulk of that will fructify. So I do think that the 2-year yield is pretty much approaching a top, but the 10-year yield is a different kettle of fish. And I do think that there is more upside for 10-year Treasury rates.
Okay, Ben, thanks very much. Ben Ram, Bloomberg Markets Live. Thank you very much. Remember, you can get more analysis from the Markets Live blog. MLI Vigo is the function to use on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. In China, the government's taking more steps to reassure investors nervous about growth and COVID lockdowns. The central bank pledged to support the economy through targeted financing for small businesses. Plus, it promised a quick resolution of the ongoing crackdown on technology firms. Russia's Foreign Minister Sergei Lavrov warns that there's a serious danger of nuclear conflict. Lavrov told Russian TV the risk cannot be underestimated. He also said that peace talks with Ukraine's negotiating team would continue. And a big week for earnings. We've heard how European banks, UBS and HSBC, are navigating the market turmoil. And now that the Twitter deal is done, we will hear from other tech names: Apple, Amazon and Alphabet. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz over in New York. Matt Miller is off today. And Kriti, as we head towards the European session, today feels like we're in a bit of a holding pattern after yesterday's quick about-face in markets. A whole new theme, or a seemingly new theme, or back to maybe a theme we should have been playing for a while but had forgotten.
Yeah, it kind of seems like that. At least here in the States, it seems like a little bit of a risk-off move. But to your point, a marginal one at that. And this is important because you see futures down 0.3%. You have the 10-year yield getting a little bit, or 10-year notice, as they say, getting a little bit more of a bid, 3 basis points lower. But remember, just 3 basis points this early in the trading session, even in the pre-market, is a big deal. Remember, we've been seeing moves of 10, 11 basis points. So we're really going to keep our eye on that. Crude, of course, down 1%. But once again, compared to the volatility that we've seen lately in the oil market, a 1% drop isn't that bad, just given the context that we're in, talking about supply chain, talking about demand. So we're going to keep an eye on that volatility. But to me, and Matt Miller would be very proud of me for saying this, Bitcoin, very important asset to watch because it's actually up 0.8%. But once again, put it in context of the volatility. A normal move for Bitcoin on any given day, a 1 standard deviation move, if you want to get nerdy, is about 4%. So to see it only up 0.8% on a broadly risk-off day when you look in the other asset classes, that's significant. We'll see which side wins. The risk-off you're seeing in futures or the risk-on you're seeing in Bitcoin, Kailey.
I love the Bitcoin talk, Kriti, and we'll be talking much more about that on Bloomberg Crypto later on today, 1 p.m. Eastern Time. Shameless plug. Don't miss it. Now, as for the action in pre-market trading, of course, the story that really continues to dominate our focus on the corporate side would be Twitter and Elon Musk's deal to buy the company for $44 billion or $54.20 a share. Interestingly, though, the stock's still trading below that in early hours, right around that 52 level, only up about 0.6%. Now, of course, there are questions we still don't know the answer to, including how exactly is Elon Musk going to come up with that $21 billion in financing that he is personally guaranteed? What will it mean for his Tesla stake in particular? You saw Tesla down a little bit yesterday on questions surrounding that, but right now it's up about 0.4 in early hours. Then, of course, aside from that acquisition and the take private of Twitter in the technology space, it also is a big earnings week, and we'll be having 2 giants reporting after the bell, both Alphabet and Microsoft, both of them at this point unchanged in pre-market trading, Anna, as we wait for those results.
Yeah, absolutely. A lot to focus on technology, from Twitter to all of the earnings stories due out this week. So a big focus on technology, as you point out. Stocks here in Europe then gaining up by 0.9% across European equity markets. But really, we're playing a little bit of catch up with the better mood that we saw on Wall Street yesterday. And some of that was provoked by that Twitter news. And so we shouldn't skirt over that. Kailey, that was a big focus. Just jumping in here, then the Brent crude price as well, down by 0.7%. So not the size of moves we were seeing yesterday, but we are continuing continuing to see a little bit of movement lower in the oil price as a result of our reevaluation of what's going on in China and the growth story there. That also hurting the euro today. UBS in focus, up by 2.4%. The investment banking side helping out the business, where the wealth management side was perhaps a little bit more lacking. HSBC also in focus, down by 3.5% as the bank had to acknowledge that returns of cash to shareholders in terms of buybacks a little bit less likely given the capital ratios they just reported. Quick focus on Russian assets for you then. This is what we have on Russian stocks as we work our way through this week. And interesting to look at where the ruble is. The ruble gaining a little bit of ground this morning. We are working towards, of course, a rate decision from the central bank over in Russia on Friday. That'll be a focus for those still playing in what is a fairly broken market at this point. Kailey?
Yeah, a lot of questions surrounding the Russian market, Anna. Let's get more on these markets with Marija Veitmane, Senior Multi-Asset Strategist at State Street Global Markets, joining us from Milan, Italy. So, Marija, as Anna was just detailing, you have major questions around Russia and the war in Ukraine. We have questions now about growth in China, the tightening of monetary policy here in the U.S. and in Europe with the specter of higher rates. Why are you still constructive on the equity market longer term?
Yeah, I mean, I have been quite bullish on equity market for quite a few years. And for me, one of the there really have been absolutely two key drivers over long term for stronger equity performance. One is how high interest rates can go. And right now, central banks are faced with big inflation problem, and we have very, very hawkish rhetoric coming from there. And what we're expecting is very, very front-loaded hiking cycle. However, if we look far ahead, what is market pricing in the kind of long term? It's still we probably will have negative real Fed funds for almost a decade. So monetary policy in our book is still fairly accommodative. But more importantly, right now is the corporate earnings, and corporate earnings so far have been very reliable, very strong. So equities are almost in the world of very very challenging, volatile market can offer you this kind of port of stability given the strength of the balance sheet and stronger earnings coming through. So earnings really important right now.
Okay, so earnings really important. That's a big focus for us this week, of course, Marija. Good to speak to you. When you look forward, though, and it's usually the outlook statements that get the attention really from investors when it comes to those earnings stories, are you getting any sense of how nervous we should be about the inflation that is still to come and the ability or not to pass that on? Because there are signs in certain Western economies of consumers stumbling.
Yeah, no, absolutely right. So my favorite way to get corporate guidance, which is incredibly complicated, as companies always kind of talk about it in a very kind of subjective and descriptive way, so very hard to get hard numbers. So the way we try to assess corporate guidance is to look at analyst estimates since the start of reporting season, or maybe even prior to the reporting season, what kind of analysts hear from companies. And since the start of the reporting season, I mean, we only have like a couple of weeks of it, but earnings estimates have been, and particularly margins estimates, have been fairly reliable. So margins have been fairly flat in most of the countries. So Europe is really one place where we're seeing weakness, and I suspect that's a lot to be attributed to the war in Ukraine. So supply chains are disrupted, and European companies are likely to see the highest increase in commodity prices and energy costs. Consumers are likely to be squeezed the most. So Europe is one area where we're seeing weakness in margins. But broadly, if we look broader, like US and kind of Latin Americas and kind of commodity-rich areas, Pacific ex-Japan, so margins there actually seem to be quite robust, quite stable. So I think broadly speaking, it's still okay, and I think we're kind of relying on the still cash saving and strong corporate balance sheet to offset the rising costs, but that's definitely not true everywhere.
Marija, when I think of inflationary pressures, I tend to separate them essentially into two categories. Essentially, the pre-war inflation that you saw in housing markets, auto loan markets, for example, the cost of living, versus, say, the commodity pressures that have really been exacerbated by the war in Ukraine, as you mentioned. I'm curious, though, of the role that China plays here. If you start to see mobility data, for example, point to lower exports coming out of China, does that actually pressure some of that pre-war inflation that's been easing so far?
Yeah, no, I think you're right. So there are, I mean, right now inflation is, all kind of pull and push factors and kind of very, very multifaceted. So we can't really think about it in a kind of traditional way. But thinking about China, I think it's the way we try to think about it, and the way we'll look at a lot of kind of media coverage of shortages, and before Chinese lockdowns, particularly in corporate communications, we saw focus on shortages started to come down, particularly like labor shortages was coming down. So that was encouraging. So Chinese lockdowns, that can potentially offset this some improvement in terms of kind of production bottlenecks. So that can potentially get a little bit more complicated. But I guess it's probably very, very strongly depends on how long the lockdowns will last in China. I mean, the latest report we heard was that some production activity is still allowed, so employees just have to kind of isolate within factories. So some activity is happening, and how much of it will be allowed to happen is, still unknown. But just prior to kind of outbreaks of COVID in China, we saw some improvements that gave us kind of some positive
and Marija, of course, that has implications for companies, technology companies like Apple, which have production and assembly centered in China. On that note, how are you thinking about technology more broadly, considering we have the giants reporting earnings this week?
Yeah, I mean, you probably remember us being very constructive on technology stocks for years. And for us, the real key strengths of technology companies is stability of earnings and strong earnings growth. I mean, we keep pointing back to the fact that technology companies were pretty much the only companies in the last decade that consistently invested in R&D. So they were able to build strong margins, strong moats around their businesses. So that's kind of, for us, has always been kind of bastion of stronger earnings. That's probably still true. And we're particularly attracted by the fact of like companies have still lots and lots of cash on their balance sheet. They're able to spend, they're able to pay buybacks. So that's in the current world, where there is hugely uncertain and kind of lots of kind of pressures coming from tighter policy. That's really, really, really strong advantage technology companies are having.
Okay, we'll watch that R&D spend then, Marija. Thank you very much for joining us. Marija Veitmane joining us there from State Street, Senior Multi-Asset Strategist. Still ahead, we will hear from Lloyd's of London Chairman Bruce Carnegie-Brown to talk about life in the city, to talk about the way the insurance sector is navigating war in Ukraine and much beyond. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Mike Mayo, Wells Fargo head of U.S. Large Cap Bank Research. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. UBS leaned on traders at its investment bank to post better than expected profit in the first quarter after its key wealth management business was hit by slowing client activity and rising costs. CEO Ralph Hamers spoke to Bloomberg's Manus Cranny about the bank's outlook.
Asian investors are more in a wait-and-see pattern, so you see transaction income down from a year ago. However, net new fee-generating assets still positive, also in Asia, so more money coming into mandates there. And then you see that in EMEA and Switzerland, you see a real pickup of demand in terms of investment, and also the US. So, indeed, one region may be still muted from a transaction income perspective. However, money flowing in, even in that region.
The biggest threat, you say it's an extraordinary quarter, and you name a lot of reasons. In your view, what is the biggest threat to the rest of the year?
Well, if you look at just to come back to this quarter, because the current circumstances have both challenges and opportunities, and that's what you saw this quarter as well. And I really want to make that point. The challenges are, okay, what is going to change tomorrow? The opportunity is, how are we going to help our clients with liquidity, with execution? That's how we delivered our best quarter ever in global markets, for example. That's the opportunity. The threat is, okay, is transaction revenues going down on the wealth management side? but we see more and more money still coming through. So our brand is out there as a beacon of stability. Our capital strength shows that clients have trust in us. So you see opportunities and threats, and with things being so unpredictable, you can only rely on what you're really strong at, which is your own advice and your own stability, and that's what we bring to our clients.
When I look at China, there's a sense of panic in the currency market. Growth levels are being stripped back aggressively. Do you see any material deleveraging or risk in your business in China and Asia?
Well, we have seen deleveraging in the last 3 quarters in Asia Pacific specifically. So yes, we saw that, and that is normal because on the back of a lower market, you also see deleveraging because generally the leverage that we provide is basically financing the position in the stock market. So if the stock market goes down, the leverage goes down as well. So it is almost a mutatis mutandis relationship there. So yes, we do see that. On the other side, we also see that investors, also in Asia, are looking at recycling their risk. They are looking at managing their liquidity. So there's also opportunities there with a very strong investment banking quarter, also in Asia.
That was the UBS CEO, Ralph Hamers, there speaking with Bloomberg's Manus Cranney. Really interesting here to think about what this tells us about how the wealthy then have handled the war in Ukraine and what they've done from a managing their money perspective, Kailey. And interesting to see then that wealth management reported a 19% drop in transaction income. So the wealthy sitting this out and saying we're not going to participate, whilst investment banking managing to actually make some money out of this.
Yeah, the investment banks, specifically trading, Anna, is really what these banks have to rely on, because not just on the wealth management side, on the deal-making side as well, the war in Ukraine has caused a lot of, I guess I would say, a cooling in that market in particular. So they're really having to lean heavily on trading.
Yeah, and we certainly saw that coming through as a theme in the US bank earnings season. Coming up on this programme, Lloyd's of London chairman Bruce Carnegie-Brown will be with us shortly to talk about the insurance sector and how it copes with war in Europe. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz over in New York. Now, Russia's move to transfer foreign-owned jets to its own aircraft register amid foreign sanctions has triggered a wave of insurance claims. However, Lloyd's of London sees the cost of the war as less than estimated by some, perhaps, saying that insurers' liability was limited to around 10% to 15% of the asset value of jets struck in Russia. We'll get into that detail in just a moment. Lloyd's chairman Bruce Carnegie-Brown joins us now. He's just come rushing. Actually, I'm not sure if he's been, I was going to say running, but I'm not sure if that's true, from the Guildhall, where he's been discussing the future of financial regulation at City Week. So you've been talking about regulation this morning, Bruce. Good morning to you. There's clearly a lot of interest in what you've been saying about aviation, so we'll get to that in a moment. But the sober issue of war on the continent of Europe, this must be impacting your business. That you must be seeing the Lloyd's market must be seeing claims coming from all kinds of parts of the global economy. How does it leave you positioned and those who operate at Lloyd's positioned?
Well, good morning. Yes, I mean, these events are, of course, shocking, and I think it's quite embarrassing to be a European to see that we've got yet another war on our continent. In terms of its impact on the insurance market, relatively muted on a direct basis. Less than 1% of Lloyd's revenues come out of either Ukraine, Belarus or Russia itself. So the issues are mostly second-order risks for us, and you alluded to aviation there a moment ago. Clearly, there are big fleets of Boeing and Airbus jets that are leased mostly by Irish companies to Russian airlines. And so those have been impounded. And as an example, we then move from understanding what the asset values of those aircraft are to what the exposures are for the insurance industry, and then, of course, down to what the losses will be. And of course, it's relatively complicated because different risks are covered by different insurers. So hull risks are different from engine risks, are different from the risks of the airline itself. And then, of course, some risks kick out when war occurs. There's a cancellation event when a war occurs, and other risks kick in. It's also multifaceted. So there are specifically issues around political violence, of which this is clearly an example. There are credit flows in terms of the insurance of credit payments across borders. So we're still evaluating all of that, and quite hard to put a number on that. I think we will have a number for Lloyd's exposures by the end of May, and most companies will have to be thinking about what provisions they're putting up for their half-year results.
OK, so it's not as simple as taking the value of the aircraft and saying, well, these aircraft were insured, therefore this is the number. It gets more complicated than that. Is it because some policies simply don't apply at times of war, then?
Well, of course, there's a sanctions regime as well in terms of what you're allowed to cover and what you're not allowed to cover, because if your insurance is deemed to be supporting Russia, you have to cancel it straight away. And of course, that will be a discussion, because arguably the beneficiaries of our insurance policies are actually mostly non-Russian owners of these planes that happen to be leased to Aeroflot and other airlines. So those kinds of issues need to be worked through. There is a right of termination in most insurance policies related to war events. So unless you've bought a war cover, you may not be covered for that kind of event.
Is there any parallel with any period of history here? I mean, I'm thinking about the immediate aftermath of 9/11, where it seemed for a period that perhaps aviation, planes wouldn't be able to fly because there wasn't any insurance to cover it, perhaps, and governments were forced to temporarily step in. Is there any sort of parallel with that period at all?
Some, and so actually the industry is pretty good at adapting to these changeable events. It's the whole purpose of insurance is to take risk off our customers' balance sheet and take it on to our own. What's I think a bit different here is sanctions policy, because that is more coordinated than it's ever been. There were no sanctions post 9/11. Certainly not in the immediate aftermath of 9/11. And of course, it's important that different jurisdictions manage these in a coordinated way, because otherwise gaps in risk and coverage occur. So we've been spending quite a lot of time on that issue.
Can I ask you about something completely different? And that is, we're sitting here in the City of London, and your business occupies a really iconic building in the City of London, designed by, very famous architects, and a real piece of architecture you can pick out, certainly from a distance. Are you planning to stay in that building? We understand that you're negotiating with landlords at the moment, and it's a beautiful thing. We're showing pictures of it now. Are you planning to stay there?
Well, we'd like to stay there. Clearly, we want to drive a hard bargain with our landlords, so it's unsurprising that there would be noise out there. There's a break in the lease in 2026, 2026, which I think would be too soon for us to move out, and so the focus is really on 2031, which would be the next break. I'm hoping we'll reach agreement with our landlord actually in the next few weeks, and that we'll have an outcome that allows us to stay.
So we'll look for agreement there then in the next few weeks. There's been protest activity outside your building, Extinction Rebellion, very active in the City of London. Are they, they're asking you to withdraw insurance from certain parts of the fossil fuel industry, but you've already made some moves in that regard. What's the latest?
Well, I think we've got to go through a transition, and our job is to support our customers going through that transition. We need it to be urgent, but it needs to be orderly as well. And so we're trying to avoid cliff edges for our customers, but we absolutely recognise, and we've made commitments to getting to net zero by 2050. And to the point you've already made, we've made some guidance to the market about not underwriting new thermal coal projects.
OK, all right. Thank you so much for joining us, Bruce. Bruce Carnegie-Brown, the Lloyd's of London chairman, joining us here, hot on the heels of his appearance at City Week. European equity markets on the back foot, down by 0.9%. US futures negative 0.3% this hour. This is Bloomberg.